All right, let's talk about something that can take a real bite out of your investment profits, capital gains tax. Especially with some big rule changes happening right now, you absolutely need to know how this works if you invest or own any kind of property. So if you've recently sold a house, maybe cashed in some stocks, or even parted with a piece of jewelry, then this one is definitely for you. We're going to break down exactly what you need to know, nice and simple. Here's the game plan for the next few minutes. We'll look at what actually triggers the tax in the first place, run through the new calculations, and then the good part, how you can legally save some money. And of course, we'll wrap up with the key takeaways. Let's jump right in. Okay, first things first. What actually kicks this whole process off? You see, it's not as simple as just owning something. For a capital gain to even be on the table, two very specific things have to happen. First, you've got to have something called a capital asset. And the thing you have to get your head around is just how broad this definition is. We're not just talking about your house or your stock portfolio. It covers land, buildings, jewelry, you name it. So having the asset is part one. Part two is the transfer. This is the action, the event, that makes any profit you made taxable. And get this, it's not just about selling. If you exchange an asset, give up your rights to it, or even when a bond matures, all of that can count as a transfer. All right, so you've transferred a capital asset. Now we get to the most important part of this whole thing. Think of it like a fork in the road, because the path you go down from here completely changes how your tax gets calculated. You know, everything that happens next, it all boils down to one simple question. How long did you own it? That one factor and that one factor alone splits your profit into one of two buckets. And each bucket has totally different tax rules. And this leads us to our two paths. If you hold it for a shorter period, it's considered a short-term capital asset. Hold it for longer? Well, then it becomes a long-term capital asset. Simple as that. The exact timing can change depending on what the asset is. But just remember, this distinction is the key to everything. So how does this all shake out in actual numbers? Let's get into the new tax math. And this includes the really important updated rates that have just kicked in. Now, figuring out the gain itself might sound a little intimidating, but trust me, the formula is super simple. You just start with the final sale price. From that, you subtract what you originally paid for it, any cash you spent improving it, and any costs from the sale itself, like brokerage fees. What's left over? That's your capital gain. And here's why we're talking about this right now. The tax rates on that gain, they've changed. Big time. If your transfer happened after July 23rd, 2024, you need to pay close attention to these new numbers. For long-term gains, the new flat rate is 12.5%. But listen, that's not even the biggest news here. The real game changer is that the government has gotten rid of the indexation benefit. This was a huge deal. It lets you adjust your purchase price for inflation, which lowered your taxable profit. Without it, your taxable gain is likely to be much, much higher. Now, for all you stock market investors out there, there's a specific rule for long-term gains on listed shares and equity funds. The rate is also 12.5%. But you get a really nice perk. The first 1,25,000 rupees of your gain in a year is completely tax-free. That's a big help. But on the flip side, what if you sold those exact same shares for a short-term gain? Well, the new tax rate on that is a flat 20%. You can really see how just holding on to an investment a little bit longer can make a huge difference to your final tax bill. Okay, but what about short-term gains from things that aren't listed stocks, say property or some debt funds? The rule there is totally different. That profit just gets added to your total income for the year, and you pay tax on it at whatever your normal income tax rate is. Phew! Okay, we've talked a lot about the tax itself. Now for the really good part, how you can legally and smartly reduce it. The law actually gives you specific ways to lower your bill if you reinvest the money. Let's look at the main ones. So here are the most common exemptions, laid out nice and clear. For example, Section 54 is a big one. It lets you save tax if you sell a house and use that profit to buy another one. Section 54EC is another popular choice. It lets you park your profit in specific government bonds and defer the tax. As you can see, each one is designed for a different scenario. But, and this is a huge but, claiming these tax breaks comes with very strict rules. You've got tight deadlines to reinvest the money. If you sell that new asset you bought too quickly, guess what? You lose the tax benefit. And you can't claim an exemption for more than your actual profit. You have to follow these rules to the letter. Okay, we have covered a ton of ground. Let's bring it all home and just crystallize the most important things you need to walk away with from this explainer. So here's what you really need to remember. 1. Selling almost any asset can trigger this tax. 2. How long you held it is everything. 3. Those new key rates for stocks are 12.5% for long-term and 20% for short-term. And 4. You can save a lot of tax by reinvesting smartly. When it comes down to it, planning your sale ahead of time is your best possible strategy. And that's the new landscape for capital gains. You've got the rules, you've got the new rates, and you've got the strategies. So the only question left is the one right there on your screen. Now that you know all this, how will you plan your next move? Thanks for tuning in.